Brian, we talk about asset allocation a lot, and it doesn't really matter if you have 50,000 or 5 billion. Asset allocation is a real thing. And we do that for our clients all the way from startup to comprehensive wealth management, all the way to private client. But we took a look at some pension funds over the past week, and we see them starting to change some of their asset allocation, and we found it interesting.
When you look at the pension universe, it's really interesting as far as what is their objective. It can be a little different than the objective of individual investors. So if you think about those classic defined benefit plans where the employer was socking away money to pay out employees some sort of deferred compensation or annuity over time, they wanted to try to fund those. And the massive increase that we've seen in the equity markets has actually made that a little bit easier for them to fund it. Also, this increase in interest rates has made it easier to fund those. So a lot of these private and public sector pension plans are doing a lot better. And as a result, they have been actually taking a little bit of money off of the table because they don't
on the equity side.
On the equity side, right. Especially.
So, but I want to make sure. I mean, the money stays in the washing machine. It's just
does.
Just gets thrown around, right? Yeah.
Yep.
So they are taking some money off of the equities because they had a 10% movement in the first quarter, which was a good year, and they're starting to shift that.
That's right. So of the $9 trillion that are in pension plans, it's estimated that maybe they're going to make about a 5 percentage point move out of equities more into higher yielding fixed income. One of the questions that we get from a lot of clients is, if I am making 5 to 5.5% on my money market fund, why would I want to own equities? Well, you just have to kind of look back at what happened with equities over the last year where you're up more than 20%, right? So it is more risk, but the higher yield on cash does create almost like a higher hurdle rate for investors to kind of think about when coming to the point of deciding how much risk do they really want to take on. Maybe they can dial it back a little bit now that yields are high as what they are.
They're moving these dials around. And of course, the quarter that we just ended here at the beginning of the year in 2024 was the best quarter we've seen since first quarter of 2019. So this is an opportunity to rebalance, if you will. No different than what Mrs. Kuskavevitz is going to do, right, in her portfolio. But make those moves right now. But they do have something that she may not have in their portfolio, and that's private equity and private debt.
That's correct, yeah. So when you do look at higher net worth individuals and these pension plans, they do have a slightly bigger toolbox, right? You do need to be, say, accredited or qualified in order to invest in certain less liquid securities. And that's actually what a number of pension plans have been doing, is looking at private credit. If you think about a traditional mutual fund that invests in bonds, they're looking at more private structures that sometimes can go to a much bigger pool of people that they're lending money to. So the yields there can be higher, but it is almost slightly more exclusive club in order to be investing in that. So for a lot of our higher net worth clients, we do work with them as far as determining whether or not private equity, private real estate, or private credit, or even private infrastructure, are those going to be appropriate? Will it help them achieve their financial goals or not?
And let's go through just a real basic example of the vehicles that people can use. Of course, everyone knows about mutual funds, but there's an institutional style mutual fund which pays a lower cost. Obviously, what's happened over the last couple of decades is exchange traded funds, really all the way down to sectors or countries. They can really get specific, and then individual stocks and bonds. And of course, when you talk about bonds, there's really a couple levers you can pull. So all of this really means going through this portfolio.
It does. And then when we're looking at the private markets, it's a slightly different structure there where it might actually be a partnership. So it's not necessarily something that you just can log into your account and invest in. It's actually oftentimes structured as a limited partnership, a lot more paperwork involved. And it's also requires a lot more due diligence. And by due diligence, we just mean that it's really that footwork that you do to understand what's in there. Then also, what are all the fees? Because sometimes the fees can be quite a bit higher than what you see in exchange traded funds and mutual funds.